you just don't know on the macro side what the trigger is going to be, but the foundation of the thesis is there. And it's the same with oil. It's the same with agricultural commodities, with gold, with silver. And people get too hung up. Oh, gold is up. It's about to make new highs, but silver is not moving. It's not leading the way. I don't think this is a real movement. Just don't get too hung up on those things. I mean, this is the time you want to be focusing on assets that are high quality, that actually have exposure to silver, or things that will probably lead the way to the upside as you see a gold cycle. So, and I think this is just the beginning. I think we're going to see a lot more. So, I'm super excited because I think this is a generational wealth kind of opportunity right in front of us.
Tavi Costa, a prominent figure from Crescat Capital, recently shared insights on the sentiment within the resource sector, shedding light on potential opportunities. At the New Orleans Investment Conference, Costa expressed prevailing anticipation for a breakthrough in the gold market, emphasizing its pivotal role in catalyzing broader positive trends. According to him, the awaited gold breakout is not just a possibility, but a certainty, with a domino effect expected to impact other commodities. While gold experienced a stabilization below one-week highs, influenced by a resilient dollar, Costa remains optimistic. The U.S. Federal Reserve's apparent conclusion of interest rate hikes serves as a stabilizing factor, providing a floor under gold prices. Costa identifies a classic technical setup in gold, indicating the potential for an upward movement. There are encouraging signs of flat inflation in October, compared to the previous month in the macroeconomic landscape. This development raises hopes that the persistent grip of high prices on the U.S. economy is easing, potentially signaling a green light for the Federal Reserve to halt further interest rate hikes. Costa underscores the multifaceted factors contributing to the potential bullish trend in gold. From a technical standpoint and a broader macroeconomic perspective, he notes the significance of gold as a catalyst. He draws attention to inflationary pressures in the current economic landscape, comparing them to historical periods. Join us as we delve into insights Tavi Costa shares with Investing News. To stay updated with our latest uploads, be sure to subscribe to our channel and activate notifications. Thank you.
Technically speaking, and by the way, technicals don't matter, right? There is other things that are much more important than this. But to answer your question, there's something called a double top. A double top, you should be very careful. Usually when that happens, which is what's happening right now with FANG stocks, the Magnificent Seven, and some other issues. When you look at those businesses, yes, that type of technical formation is very bearish. Now, a triple top usually is something that it falls. It does mark a top initially, but then what you see is a true recharging moment of the asset price, and then you see a much higher breakout that tends to be what drives the beginning of a long-term cycle. So to me, gold is in a classic technical setup for that. Now, the macro is even more interesting because the U.S. and other developed economies are facing, in my opinion, something very unique. It's sort of a chronic debt crisis with embedded inflationary forces. And the U.S. economy, and not just the U.S., but other developed economies too, they're completely heavily reliant on fiscal stimulus at a time when we already have government debt at levels that we've never seen unless you're talking about war periods. And so I don't know how we're going to, really balance all those things without making hard assets a much more relevant portion of the economy. And then you look at 60-40 portfolios, or those what they call the traditional investment strategies, and they don't allocate any capital to hard assets. So how do we, how can we even come up with a bearish view on those things? And what are hard assets? Those are commodities, gold, and so if you're driving, let's say, if you're managing a portfolio, a very kind of traditional portfolio, and now you hold 40% of bonds and so forth, you're in a kind of a pickle. You want to own some of gold as a defensive alternative. Same thing for central banks. Central banks enhancing the quality of their international reserves. And so you're starting to see some shifts happening already. It's creating shifts in correlations too in markets. And I think this is just the beginning. I think we're going to see a lot more. So, I'm super excited because I think this is a generational wealth kind of opportunity right in front of us. The technical already kind of said a little bit about it, but even from a macro side, taking away just the fact that if you look back in other gold cycles, I would say the 70s, we had a kind of an inflationary time. We broke the gold standard, so that drove gold prices higher. We saw some accumulation of gold by central banks. In the early 2000s, we had the second cycle in gold, and that was really driven by China entering the WTO, becoming a manufacturing plant of the global economy. They drove commodity prices higher, then gold prices went a lot higher too. But we didn't see central banks buying gold at that time, which is really interesting. And today, we kind of have both environments happening. All G7 economies have to reshore and really revamp, like I said, their capabilities, industrial side, on manufacturing side, even on the public side in terms of airports and highways and all sorts of things. All that requires materials. And then on top of it, I think what we're seeing today is quite inflationary compared to other periods. And, if you look at the forces, deglobalization is a large one, reckless fiscal spending, the chronic underinvestments in natural resource companies, all those things, the affordability of housing. How do you fix that issue? You're going to have to build more. So inequality problems. What happens with inequality issues? Well, you tend to see more social programs. So all those things are kind of playing a role into creating this a much more inflationary era that is eventually drives investors back to precious metals and tangible assets overall.
Costa contends that the conventional 60 or 40 portfolios, comprising 60% stocks and 40% bonds, are historically overvalued. Costa anticipates a forthcoming shift in allocation strategies and suggests that commodities, with a particular emphasis on gold, could emerge as competitive alternatives to treasuries. The benchmark U.S. 10-year Treasury yields recently hit a nearly 2-month low. Despite a significant drop in the dollar in yields, gold's modest increase suggests a cautious approach, indicating potential unwinding in the geopolitical risk element associated with the Israel-Hamas conflict. Costa identifies a risk-reward opportunity and advocates for a reevaluation of portfolio compositions, recommending a higher allocation to gold and a diversified basket of commodities. Let's get back to the interview.
If you looked at 60-40 portfolios as kind of the aggregate valuation of those, so if you take the valuation of the equity markets, give a 60% weight, and take the bond market, give it a 40% weight, aggregate that all the way to the 1800s, you're going to see that right now we're one of the most overvalued periods in history. And you may say, well, but the bond market already fell apart, and maybe there is more opportunities there and so forth. But in aggregate, they're still very expensive. And the problem is one feeds the other. So if rates start moving higher, then you have to discount companies' present value of businesses lower. And so those two allocations need to be redefined. I think gold is going to kind of be one of those assets competing with treasuries, just like central banks have been changing their allocation. I mean, back in the 70s, they used to own 80% of gold relative to treasuries. Now it's the opposite. So can we see, just going back to historical average, maybe 50% of central banks' assets is in gold? That would be a huge change. And so, or there was a research recently on how much gold advisors own today in their portfolios. 70% of them said that they own less than 1%. So how much do you have to lose in here? So to me, that's the type of kind of risk-reward opportunity that I enjoy kind of looking for. I think that's going to be one side, gold, and then a basket of commodities will probably take the other side. And I would say emerging markets, especially resource economies like Brazil, will probably take a part of the equity market portion. So that's going to be a very interesting way of allocating capital over time. And so I'm also really, really interested in that market. Do you know what the difference is of what is the definition of a long-term investment? Have you heard of that before? It's a short-term investment that didn't work. So, all of us want our investments to work in the next day. And unfortunately, that's not how it works. But back in 2018, just to be very clear, I started really looking at the CapEx trends of natural resource companies, and you can kind of see when that bottoms out, you tend to see a bull market in commodities. And this is, you just don't know on the macro side what the trigger is going to be, but the foundation of the thesis is there. And it's the same with oil, it's the same with agricultural commodities, with gold, with silver. And people get too hung up. Oh, gold is up, it's about to make new highs, but silver is not moving, it's not leading the way. I don't think this is a real movement. just don't get too hung up on those things. I mean, this is the time you want to be focusing on assets that are high quality, that actually have exposure to silver, or things that will probably lead the way to the upside as you see a gold cycle. So I feel like everything is really coming together right now, and the sentiment is really bearish, even among most of the people that are speaking in this conference. I mean, if you talk to them off camera, they're not very bullish right now. And I'm not going to name names, but I am not that way at all. I'm extremely bullish. I'm really focused right now because I do think this is the time to be. Like I said, you don't want to lose focus at the wrong time, and I think the majors are doing that. And I don't think money managers should do the same. So,
in a recent tweet, Tavi Costa highlighted a compelling correlation, noting that substantial declines in the dollar have historically coincided with significant turning points for gold. This observation neatly corresponds to the metal's current momentum, poised for a potential breakout from a notable historical triple-top pattern. Following this week's gains, gold is seeing some routine profit-taking from the shorter-term futures traders. Near-term, we may still need to see a move in gold prices above yesterday's high at the $1,970 level to potentially pave the way to retest the psychological $2,000 level next, IG market strategist Yap Jun Rong said. In a recent interview with Kitco News, Carly Garner, co-founder of the brokerage firm DeCarly Trading, said that she is neutral on gold after its latest rally has once again lost momentum at its $2,000 an ounce level. That's all from us. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.